Hey guys, my name is Sharad. I'm your host of REsimpli podcast, and I'm super excited to have Jay Tenenbaum on this REsimpli podcast. He's an expert in mortgage and notes, so I'm really interested to kind of speak with him. Jay, welcome to the show. How are you doing?
Terrific. Thanks for having me.
Yeah, absolutely, man. Where are you joining in from?
Scottsdale, or Phoenix, Arizona.
Oh, cool, cool. Yeah, Jay, let's get started. Tell us a little bit about yourself. How did you get started in real estate investing business and kind of, what you're doing now? What led you up to this point?
Certainly. I've been a real estate investor for about 10 years now. And actually, that kind of was the only real estate investing experience I ever had. I don't come from a generational family with real estate investors. The only real estate that I knew was, buying and owning my own homes for over the course of time. I was a debt collection attorney for 20 years with my wife prior to that. And basically, I just, I say I've been in debt all my life, just not personally, right? Um, and I mean, I got an opportunity to go to a seminar in August of 2013. It resonated with me because it was just another different debt instrument that I've been used to, pursuing. So it came kind of natural. And it's over 10 years, course of 10 years, it's grown. We've done probably, well, since I've been with Scottsdale Mortgage Investing, which we founded in 2000. I came on board in 2018. My partner actually started the LLC, but it wasn't doing much before that. Um, and we've done probably 300 plus transactions, about $75 million worth of value in since really since 2018.
So what's about, investing in like notes that attracted you over, let's say, going the traditional route of real estate investing, like buying rental property, fix and flip. I'm always curious, when people take like non-traditional route of investing, like what is it that led them down that path?
Good question. It kind of evolved over time a little bit. Prior to the opportunity, the seminar I went to in August of 2013, I'd gone to other seminars and the education over the weekend was great. But, you leave those kind of opportunities going, well, come Monday morning, how do I find my deal? How do I find my deals, right? And that was always to be my stumbling block. Like, how do I do this? Well, this particular opportunity, the guy that did the seminar, introduced us, cocktail party. He had a cocktail party after one of the nights. Introduced us with other hedge funds, other seller relationships. So plus he's, part of his package was his Rolodex of sellers, right? So here all of a sudden, like, wow, I have access to sellers, how I can get deals, access to people having deals right away. That's probably what resonated and why I wanted to jump into this. It was something that I could understand. It wasn't that difficult. I had actually been investing in judgment liens in California prior to about 3 years prior to doing this, so I understood title and priority of things and mortgages and things like that already. So now it was really a matter of you buying. The distressed mortgage world is you're buying mortgages from banks and hedge funds at a steep discount, and you're either working them out with the borrower, or you're foreclosing and you get paid off at auction or taking the properties back. And when I first went into this, I looked at it going, okay, like I said, it resonated that I have the opportunity to talk to live people with deals right away. But I guess I really, at the time, thought the expectation was I could be just like your fix and flip guy. I just was going to acquire an asset property, a potential property in a different route, a little circuitous than just knocking on doors and door knocking and stuff like that, which I didn't like. So that's how it started. It ultimately kind of evolved into, because in my debt collection law practice we had a ton of wage garnishments and payment plans and everything like that. So we were getting like monthly income coming in from the practice, whether we had lights on or not. So doing loan modification with borrowers, keeping them in their homes, became really my forte on how I started this business, creating that cash flow again. So you talk about people want to buy rentals and things, right? They're doing it for the passive cash flow. Well, I'm doing it a little different way with doing loan modification with borrowers. It's more of a win-win. It's more of a I mean, I do on rentals, yes, but loan modification is more of helping the borrower keep their home.
So how do you get started? I'm curious, like let's say I'm a brand new investor, right? Let's say I've never done this. You mentioned something about buying these, distressed loans from the banks. Are you just literally like calling banks and saying, hey, do you have, distressed loan to sell? Like, how do you go about it?
You could do that, and my mentor, but part of our mentoring program was doing that. It's a futile effort because you're gonna get hundreds of calls on banks, and you're gonna not find the right person or even talk to anybody, and probably 90% of that, and maybe the 2% you do find, they're like, well, we don't have anything. We won't have anything for next year. It's kind of a futile effort. In actuality, for me, it was more relationship building. Just the relationships that I made of going to conferences and just again from the start of who I met, in the first introductory seminar, parlayed into relationships that were fortunate enough where instead of saying, okay, I'm going to buy a loan or two from you and then never see you again, I've been able to cultivate relationships with banks and hedge funds that basically I can go to them almost monthly and go, okay, what do you have this month? So it's kind of a forward flow arrangement. So I've only worked with, probably 2 dozen plus sellers over the course of my career, but they fed me a ton of loans each.
So when you say sellers, these are banks, right? Or these are
Banks
brokers
are,
in
or
between.
had, or had, or had, no, they're not necessarily brokers, but basically the evolution is you get, for example, Fannie, Freddie, HUD, Ginny, like to put out, huge tapes, right? And the Goldman Sachses of the world will buy this stuff, stroke
Got
eight,
it.
nine
Okay.
figure checks, right? But they don't, but they're not in the business of working these loans. They're in the business of buying and acquiring as a commodity. So then they sell it to hedge fund B, who pays them a little bit more than what they paid for it, and ultimately goes down to, as we've evolved from a company, let's say, Goldman's over here and we're here. So
Okay.
we're getting loans that finally got down to a seller that hedge fund that was right just a little bit larger than us, right? As we've
Okay.
grown, we've reached a bigger seat of the table. So we're starting to get loans from hedge funds that are larger in size than we used to. So we're getting greater opportunity. In fact, it's kind of come full circle. We are actually selling loans on our trade desk to guys that I've bought loans from over the course of the years.
Oh wow. That's awesome. Congratulations on the success. And is this something you can do with the local bank also? Let's say if I'm a local investor just getting started, like how much I'm just thinking, I love the idea of doing, buying distressed loans, working with the borrowers and trying to make some passive income. But how much money do I need? And then do I need to how do I go about building these relationships that I have? I do understand that I'm starting at the very bottom level, but what are my first steps? Like, just walk me through like, 3 or 4 steps of the process.
Sure. So, the money that you need really depends on your appetite of what you want to do. And just like anything else, I mean, in the real estate business, no matter what area you're in, it's always about raising capital, right? So it's
True.
not about how much capital do I need, it's how much capital is needed. Now, that's, it depends on how much you want to grow, right? We've evolved our company, we've got a strong appetite. So we've raised a lot of capital in my career. But, to get started, two things I think is probably the epitome of how you start. One, I didn't use my own capital in my first deal because I wanted to prove the concept. I just had some capital available, and I had a couple partners that we all jumped in and bought three loans from back in January of 2014. And then I got the opportunity 2 weeks later to buy 20 loans from the same hedge fund, and I went to my mother, who had the capacity to pull off a $200,000 trade, and I bought 20 loans and doubled my money in like 9 months. They were all performing, and I sold them as reperforming loans, and paid her off, and she was happy about that. So really, it's a combination of using your own capital to start just because it's available to you. Because until you get a track record, raise capital can be difficult. You can raise capital when you first get started, but it's going to be from somebody who already likes, and trusts you. That may or may not necessarily be your family.
Right. No, I agree. I
um,
agree. I understand. Yeah.
um, Also, I think the other key to success is I would suggest partnering up with somebody who's already experienced doing it. I did. My partnerships that I created when I bought those first 3 notes were 2 guys that had already been investing in notes for a while. So I kind of piggyback
Okay.
on what were doing. Um, but if you partner up with somebody who knows what they're doing, takes the limit, minimize your risk. Now you also have a track record. It's not about how the first acquisitions finish. It's the fact that you first acquired them.
Right. Walk me through the numbers, Shay, if you don't mind. Like, give me an example of a typical deal that you would be doing. How much money would you invest in it? What would your rate of return look like on that? I'm just trying to like compare it to, let's say, buying a rental property, right? Like, I go out buy a rental property for 150, 200,000. Is that the amount of money you would need to buy loans, and what does your ROI look like on that?
So, okay, I'll answer the answer your question comes kind of two parts. I cut my teeth on what we call low balance assets. They're a little riskier. You want to diversify and buy multiple loans at a time because they're riskier. But back in 2014, 2013, 14, 15, the climate back then was I'm buying a loan. Let's say the house is worth about 50 grand in the Midwest somewhere. The balance that the borrower owes is probably at the time would have been underwater. It would have been maybe like $80,000 that they owed on the loan still, and I would have picked it up for probably $10,000 to $25,000.
Okay.
That was
On
back then, right?
okay.
Now again, you don't want to ride or die on one loan like that, so you're probably spending 50 grand, and you're probably picking up three houses for 50, in that same scenario.
And then the
So
value of those would be 150,000. You're paying about like, 33 to 40, 30 to 40% of the value.
exactly. So let's say you're taking one of the loans in that portfolio, for example, you bought it for 10 grand, and the borrower, and you work out an arrangement with the borrower that they'll pay you $300 a month. Now it's three quarters of a grape, but you got a 36% return on your money, right?
Got it. Yeah.
So, and that's cutting your teeth on small balance stuff. Now, granted, on the small balance stuff, your ROI looks really good numerically, but you're putting $300 in your pocket, right? But you got to start somewhere, right? You're not going to go
Right.
out and spend, $300,000 if you don't know what you're doing on a house that, and then landscapes change. I'll get to that in a second. So I cut my teeth on that kind of stuff, and I did it well, right? Um, cost of entry capital versus one rental. If I spend $150,000 on a rental, let's say Dallas or whatever, what I'm getting maybe $1,800 a month in rent. My cap rate isn't very good,
Right.
right? And that's not and then kind of play it out further. Let's say, for example, I bought that loan for 10 grand. I got the borrower to pay $300 a month. The value of the house is worth 50 grand. It's still underwater, but because it's now performing, maybe I've created value add by its performance, right? Now I'm probably able to sell that loan on the secondary market if I want to, right? For $30,000 maybe,
Oh, wow. So you tripled your
maybe,
money plus the cash flow that you had.
yeah, or maybe once I season it, maybe even yeah, 25, $30,000 is probably what I could get
Wow.
for maybe more.
What and what
Now in
how much
these
seasoning
days,
do you need on that?
it all depends. I mean, like I said, I can season it for 1 month. You may want to buy it at 25 grand. You may not want to buy that loan for me after 1 month. You may want me, if I season it 6 months, it may be worth more. You may be paying more. It's an open market, right?
Got
Do I
it.
want to sell
Okay.
it tomorrow, get X? And like I said, if I bought it for 10 and I only got, received a couple of payments and you want to buy it for 20 grand, would I do it? Probably. That's what I did in the first 23 loans I bought, right? I didn't really care. I just turned my money over 9 months, right? Um, as we've grown and as I've grown, now we're into the much higher value assets, right? Our average purchase is probably $250,000. Our average home is probably worth 400 to 500. Well, 350, 400,000. Pricing's gone up. You're really getting
Right.
stuff. Back in the day, like I said, the low balance stuff where I'm getting probably 30 to 50% of the dollar. Now I'm probably 60 to 80% of the dollar. Right?
Got it.
But again, in a higher value loan, there's more spread, more potential profit. Now I'll tell you, just recently, the home run of all home runs, which is not always going to happen, right? We bought a loan for $250,000. The anomaly was our seller. The area was kind of unique. There were houses on one side of the street worth about $300,000. There are houses on the other side of the street worth over $1 million. Our seller had the perception that this house was worth 300,000 and sold it to us for 250. We're paying about 70, 80 cents on the dollar for it, right? Well, it turned out the legal balance, what the borrower owed, was well over $1 million. And so we closed at the end of the first part of this month, last week, yeah. Um, on a short, we did a short sale with the borrower.
Right.
Like I said, he owed us over $1 million. We agreed to accept $952,000
Oh, wow.
on on a $225,000 purchase.
Wow. You made over
Now,
like $700,000 on that.
yeah, but that those when you're buying a lot of loans, you're buying a portfolio, you'll hit those wins, right?
Right.
You'll also hit, take a property, you missed on a property and you end up taking it back and you end up selling it at a loss just because you want to get rid of it because it's, no one bid on it at a third party sale and it's a piece of crap house. It all balances itself out.
God. So walk me through, it sounds like you need to do a lot of due diligence when you're buying loans, right? In this case, you got, I mean, I don't want to say you got lucky, but the stars were aligned and then you picked up this deal. What are the like give me like 4 steps of due diligence that you're doing on the loans that come across your table?
It's interesting that you call it 4 steps because there really is 4 primary steps. And the acronym we always use is called VOTT, VOTT. So basically, in your diligence, you're trying to determine the valuation, right? Because I'm going to buy something at 50 cents on the dollar. I want to make sure I know what the value is, right? You want to check for us because we like to keep borrowers in their homes. We prefer to buy loans that are occupied versus vacant. If the property's vacant, we're going to end up just taking it for foreclosure. Now we may do well getting it sold at a third party auction, and the auction appetite is still very strong. I mean, back before the interest rates rose, it was really strong, right? Problem was, the problem was when you're selling a loan, when you're taking a loan to auction at foreclosure, you're only entitled to receive. You're the bank, so you're only getting a legal balance. So, for example, I may be owed $385,000 as my total legal balance. The property may get sold at auction for $450,000. I don't get that difference, but I bought that loan for probably 185.
Okay. So you get only 385 and the
Right.
other 75 goes to the homeowner.
It goes statutorily to either any junior liens or judgments and then the homeowner typically, yes.
Got it. Okay.
So going
Interesting.
so going back, so we prefer to buy occupied loans because we'd rather keep the borrower in the house. We want to know what the tax liabilities are because if they're not paying their mortgage, they're probably paying their taxes. And so you don't want to get a property lost to tax sale because unpaid taxes can wipe out your mortgage interest,
Is it
right?
just property taxes or personal income tax also that affects
Property tax,
just
property
the
tax.
property taxes? Okay.
Because your personal income tax and there's liens. Remember, it's all about your title report, right? And that's the fourth item is title. Not that okay. So your title in a mortgage aspect is a little different than title when you're buying a property. Title, you're buying a property. You're saying, okay, I'm buying a property. I want to make sure that I'm buying it. The seller is the true seller. Here, when I'm verifying title, I'm verifying a couple things different. One is that my loan is recorded where it's supposed to be. It's recorded the right amount. It's recorded the right date, right? Because the seller gives you a spreadsheet that says, "Here's loans you're going to buy," and your title reports will verify that what you get on the spreadsheet is, "I'm buying this loan for this amount that was recorded, originated on X date for X amount," right?
Got it.
The other piece of it is when a loan, as I told you before, is a commodity, bought and sold as a commodity, right? It's basically saying, okay, Bank of America originates the loan. When they sell it to Goldman Sachs, that transfer is not a deed. Remember, this is all paper. Nobody's owning the property yet, if at all, right? So the transfer is an assignment from saying Bank of America to Goldman. If Goldman sells it to you, you're going to get an assignment from Goldman. You sell it to me, I'm going to get an assignment from you. So in my diligence, running my title reports, I'm looking at the recorded assignments and make sure the chain is intact. Now, that's one area that if you miss on that, your custodian can really help you fix the chain of assignments. That's easy.
Okay. So valuation, occupancy, taxes, property
And title.
taxes, and then the title report.
Correct.
So you go through this. Like, I'm just curious, like how long does it take you on average to do one loan?
In the very beginning, it'll take you hours because you don't know what you're doing.
Right.
Now it takes very little time. But I gotta disclaim that. My partner manages our analytic team.
Okay.
I'm not wired to sit in front of a computer and analyze anything. I'm just not that. I'm the deal guy. So my team runs the loss mitigation.
Got
So,
it.
but
Okay.
but but see, but part. But what makes us unique though is um, part of our diligence runs concurrent. Our analysts will run their values, right? Our analysts will look at the collateral, but so will we on the loss mitigation side. Because if we're going to work that loan, we got to make sure our collateral is intact to either start foreclosure or get a loan mod or whatever we're going to do. if the asset is already started foreclosure, we, as part of our diligence, require our sellers to give us attorney information. We want to call that attorney and say, hey, what is happening with this loan? Is proceeding to foreclosure a problem, or it's been heavily litigated? Because like, if I've got 300 assets to look at, right, and one's been tied up in litigation because the borrower's heavily contesting it for 5 years, I don't need that asset. I don't care how profitable it could be.
But what
You're gonna
but
get,
could that be part of a deal that you have to take this one asset with other like
yeah,
dozens that you're buying?
at times, sure, at
Right.
times, but you're getting a great deal. That's why with a portfolio, depending on the size, you're always diversifying your risk.
Right. So when you get this package from, the hedge funds or, whoever your seller is, do you have any like room to negotiate, or is it like the price is set? Hey, you buy it at 50 cents on the dollar, that's the price, no room
You're
for
al- you're always
negotiation.
you're always negotiating. But
You're
again,
always negotiating.
that's where our analysts come through and say, okay, we don't try to negotiate just for the sake of negotiation. Is
Right,
they analyze these deals with regards to what the profitability is. So if the seller
right,
says your price is going to be X, and we run it through our model, our proprietary model, and we know we can make, we've got certain benchmark returns that have the minimum returns we got to hit, right? If it hits, if it comes through the bubblegum machine and hits our marks, why wouldn't we'll buy it? As
right,
long as there's not other issues in diligence. Because remember, if I've got $5,000, $10,000 in property taxes, I will renegotiate that amount. Borrower, unlike real property, the taxes aren't cured. You buy these loans subject to property taxes. But if I've got a heavy property tax bill like that, a delinquent bill, I'll offset it to my purchase price. I'll fade, what we call fading the purchase price. If I'm buying a loan for 50
okay,
grand, there's 10 grand in property taxes. I'm telling the seller, I'm going to buy that loan now from you for 40 grand because I'm going to end up paying the same 50, but I'll be paying the other 10 through property taxes.
got it. And then do you buy nationwide, or are there any states that you will not buy in, or any counties or states?
We buy nationwide. I got to tell you a funny story. I think the last time I checked, I've probably bought a loan, at least one loan in probably 45 plus states.
Oh wow,
And
that is
while
incredible.
it's not a statistic that I know really off the back of my hand, but it kind of started one day. I was on vacation with my twin daughters and my wife. We were in Hawaii, and we're sitting at dinner, and my daughters, who were probably 12 or 13 at the time, start singing this song. First we start playing a game like vegetables, and we start going through the alphabet. Name a vegetable. We go around the table. Vegetable starts with A, and the vegetable starts with B, right? Then they start singing the 50 states. They learned it in grade school. There's a song that they memorized of how to name all the 50 states, and they
Okay.
come with a tune to it, right? So then the conversation morphed into, okay, slow down your song, and when you name a state, I'll tell you yes or no whether we run alone there. At least I can remember.
Right.
And when we kept the scorecard, I think it was 45 at the time.
That is incredible. That is incredible. Yeah. I'm curious, the five states that you haven't bought in, any reason? Or it's just like you haven't come across loans in those states?
Probably there's states that you don't see a lot of loans.
Okay.
I mean, in the very, if you like, I lived in California when I started this business, right? And California loans were tough to buy because A, they were priced too high, and B, they just weren't all that available, right? So I learned from the very beginning how to invest nationwide. Now, to some extent, I envy those who live in Michigan or Ohio because you're going to see on every package loans in those states, right? So you can buy in your own backyard. Now, I wouldn't want to live in Ohio and Michigan necessarily. I'm spoiled. I was living in more rural climates, but you could learn. They learn how to invest in their own backyard. It's different aspect, right? Um, but you see, there's certain. So if I was going to only invest in my backyard, and I lived in South Dakota, I'd starve. I would never know. I would never see anything. If I live in
Okay.
Ohio, I could probably make a good living in my own backyard because there's plethora of loans there.
Right.
In other states, the Rust Belt in the South, absolutely, Florida, etc. Um, but no, and now we're buying portfolios, but these are what they are.
Right. So, we had on the couple of podcasts ago, we had someone who does a lot of rental investing. And he talked about, not to get political, but he said generally when you're buying rental properties, you want to buy in red state because they generally tend to be more landlord friendly versus blue state, generally tend to be more tenant friendly. Do you notice anything like that with your note business or not really? I mean, depending on like it probably
Yeah,
depends
yeah,
on
yeah,
what
yeah,
how
yes,
strict the
yes, yes,
foreclosure laws are.
yes, exactly. Yes and no. Well, it doesn't really follow on red and blue lines, but you have to start as a starting point. You've got your judicial and your non-judicial states. Your
Right,
non-judicial states are usually like the West Coast, California, Oregon, Washington, Nevada, Arizona, etc. Right? Non-judicial states, because of Texas, your foreclosures are so fast, you're paying a higher premium for those loans.
right.
Right?
Okay,
The judicial states, I'm getting bigger discounts because going in, we know it's going to take a while. Right?
okay.
Um, they don't necessarily fall on
On
red
this,
or
yeah,
blue, red or
red or
blue.
blue.
But for example, I've got a love-hate relationship with Illinois. I've done really well monetarily, but the foreclosures take forever just because they are very pro borrower. I mean, I had a foreclosure once. It took 3 years. The lady was an older lady. She didn't want the property anymore, but she was just trying, not very hard, trying to find an assisted living facility to move into, right? And her attorney never filed a response to the foreclosure, but kept coming in at every hearing going, I want more time. My client needs more time. And needs more time. And the judge kept giving it to him. He didn't even file a response. He didn't make a formal appearance in the case.
Jay,
Yet,
you're the only one with love-hate relationship with Illinois. Everybody else has hate-hate relationship with Illinois.
but I've done really well monetarily.
Yeah, I can see that. I can see. I used to live in Chicago, so I can see. I mean, there's opportunities, but again, I would not want to touch that state. Just it just seems
So
like
for example, because that's the hate part, right? All the bureaucratic, the delays and all that. The love part was I bought a loan in Humboldt Park. Okay,
yeah, I'm familiar. Yeah,
and
that's a rough part.
okay, you're buying paper. It is what it is,
Right,
right? So I bought the loan, I think, for I want to say about $60,000,
right,
and I had it. The value, the unpaid balance was well over 200,000, and I had it insured for, again, we're talking underwater properties at the time. I had it insured for a valuation of about 150,000, I think, 120,000, something like that. And I get a call one day. The borrower's son, borrower Spanish, as you know the area, borrower was Spanish. Um, Her son was American born, spoke perfectly English. He was actually a contractor doing business with insurance companies. So the second floor of the property had burnt, had caught on fire. And so I made an insurance claim. And the adjuster came out there. He helped, the son helped facilitate the adjuster coming in. In about 3 weeks, the claim was for like $112,000. Well, I had it insured for 100. Sorry. And so I got a check for $100,000. I made 40 grand on my $60,000 investment. Right now, you're gonna say, well, if the claim was 112, I lost out on 12 grand, but I still had a loan on a partially burned out house. So I
right,
go to the son. I go, does mom want to give me, a deed in lieu? Because I still got to do something with my security interest. And we ended up negotiating a short. She didn't want to give me a deed in lieu, but he did orchestrate a short sale. So basically, I got another $20,000 as a short sale. Remember, because the balance that was owed, was well over $200,000.
right.
So minus the
So
$100,000 check, I got another $20,000. Great.
so help me understand this. Let's say you buy a note on their property for like let's say the original loan is 250. You buy it for 60,000, right? I come to you now. You are the lien holder on that property. I come to you and say, "Hey Jay, I want to buy the property for 150,000." Right? You agree to it, and sellers agree to it. So would you take that deal and make 90,000, and sellers get to write off their loan? Is that
Yeah,
something that you
that's
do?
that's I'm the bank. I'm the short. That's what be for me a
Right,
short sale. Yeah,
right. And
yeah.
then as long as the
Because
seller is on board to get it
yeah, or
going
or
and
or sellers come to us and say, I got an offer to pay. Would you accept? Yeah, less. Well, again,
got it.
if I
Okay,
bought it for 60 and it wants wants me to take 150. First of all, I can make a decision faster than in the old days when the banks took forever to make decisions. And what do
right.
I really care? I'm not holding out for that 250, especially if the house may not be worth it. If
Got it. Okay.
the house is worth 250, he'd have sold it traditionally anyway.
All right. So Jay, okay, that's very interesting. I love that part of the business. you said you're a deal maker, and then your business partner, he's the guy like who's doing the more on the, analysis side. Like, what is it about, this business that you really enjoy? Is it like making deals, negotiating with the sellers or your borrowers? Like, what is it that you really enjoy about this business?
Just the deal making, keeping borrowers in their homes is one of my strong whys, sure. Um, and just the opportunity. I mean, look, you're investing in real estate. Whoever whatever niche you're in real estate investing, you love to be a real estate investor, right? You buy rental properties because you want the passive cash flow. I'm buying discounted loans because I'm getting paper at tremendous discounts that give me the opportunity, loan by loan, to make a profit. We've talked about some of the home runs, but they're not. But that's not every day, right? There's all you get taken out at auction. For example, we go to auction on a property that we don't want to take back. We don't want to take it back, right? So the same kind of thing. We maybe owe 200,000. Property may be only worth 100. We bought it for 60. We may set the auction bid at like $70,000, enticing a third party investor to just take it off our hands, right?
Got it.
So you're not going to hit home runs every day. You don't have to.
And you will have to take it through the auction, or could you just reach out to local cash buyers in the area directly and say, hey, would you want to buy it for like 70,000 before going
Well,
to
remember,
auction?
remember, I only own the paper. I don't own the house.
Right.
So if a buyer comes to me, I'm either selling the note to them, or they've got some deal worked out. They're getting a deed in lieu from the borrower, but the borrower's got to cooperate in that process, until you get to auction. Because I don't
Okay.
know, I don't own the house. I only own I only own the
Makes sense.
paper.
Right.
In fact, maybe stuff I bought. I've never owned the house at all,
Right.
ever.
So at the scale that you're doing business now, are you, or even I'm curious, like when you first started out, were you talking to the borrowers directly, or did you have like a third party involved negotiating with the borrowers? And what does that look like now that you're doing it at scale?
um, I laugh for a specific reason.
I'm sure
Um,
you've had some very interesting stories with that.
oh, always, always. My partner and I used to be part of a real estate community where we ran masterminds, and we ran an out of state note investing mastermind. And in the mastermind, I always said, "There's our business model is open book. We'll teach you everything. We'll show you how to do everything we do, except one component I can't teach you, one component I won't teach you. The can't teach part is servicing, third party servicing, right? It's federally regulated, it's technical, it's precise. I can't teach it to you. We engage a third party servicer to service all our loans, right? That's just automatic. I won't teach you debt collection because of FDCPA and other requirements, because I'm not going to run the risk of I said something in a mastermind and it was taken out of context, and somebody called a borrower and got sued, and they said, and I got taken out of context, right? Plus 20 plus years of debt collection experience, your head would explode if you really grasp it in an hour or two, right? So I was blessed. I was blessed with the experience to talk to borrowers myself. Yes, and starting out, I did. Now, as we've grown as a company, my loss mitigation junior partner, lead, head of the department, is phenomenal. So he does all that stuff right now, right?
So
We
it's
just
still being done in-house. You're not doing it, but still
Yes,
somebody on your company. It's
yes,
not
yeah.
a
The answer
third-party
to your
company
question,
that is.
correct. The servicers are overworked. They don't do it effectively. So yeah,
Okay.
what sets us apart is the fact that we do it internally. We can do it internally, and we do it very well internally.
Got it. Okay. That's good. So looking back at your career, what would you say has been some of like, you know, the keys to you being successful? I think it was about like when you said initially, it was about like you happened to be in the seminar and you found sellers were already available, ready to sell their notes to you. So you didn't have to go down in the rat race of doing direct mail or other marketing to get motivated seller. Was that like kind of that led you to this, journey of note investing? What have been some of the other keys for your success?
Yeah. So referencing what you referenced, yeah, I'm lazy. I don't like to hunt. Door
Right.
knocking and leads and all that. That's cumbersome. That doesn't interest me at all. So yes, when you have the identifiable seller relationship built, almost from the scratch from start, that makes a lot of sense. The other keys to our success is just uh, for me, I'm not a good lone ranger. I need a solid partnership to make things work. I need a partnership. I need partners that excel in areas that I don't, and then I can revalue, in areas that they don't. And that's why my partner and I, Seti Gershberger, are good together, because I don't want to touch the analytics part at all.
All right. So, so you basically, you and your partner have found things that work for you guys, and you're like, hey, this is my part of the business. This is your part of the business. Let's just double down on what we're doing. You take over the deal making, you take over the analysis part, and then you just got kind of just double down on what's working for you. Yeah.
Exactly, exactly.
All right. Tell me one of the worst mistakes you've made as a note investor. Like, what's the worst deal you've done? Whether it's hopefully it's a decent amount of money you made, but if you lost money, like tell me about like the worst, like the note investing story that stands out for you. Which one would that be?
Well, I would. There's a story that stands out for sure. It wasn't necessarily a mistake in the analytics or the diligence or anything like that. It was just the occupant was an occupant from hell. He still is an occupant from hell.
Oh, you still
Um,
have that?
oh God, yes. So we bought a loan in Connecticut, and it was occupied, but we knew it was occupied not by the borrower. So reverse mortgage. We knew the borrower was dead. And once we got it back, the rules in Connecticut is if there's really not a whole lot of equity, it goes to what's called strict foreclosure. So it doesn't get subject to auction. We just get the deed back through the foreclosure process. So we got the deed back, and we communicated with the borrower. He wanted to buy the house and stay there. Great, make us an offer. He's one of those guys of, well, I'll gladly do it Tuesday, and the money will be available once my ex-wife's house sells. Was the house on the market yet? No. We want to come in, and before we accept any offers from you, we want to come in and see the house. Oh, my wife's got COVID. I can't let you in. So finally, we had to evict him, because remember, he claims he had an agreement to buy the house from the dead guy, but there's nothing in writing. He didn't have a lease with the guy either. He just was like there, like 6 years.
So basically a squatter.
No, he was there. Our deceased borrower put him there, but whatever
Okay.
arrangement they put him there, there was nothing in writing to validate
Okay, but
it, right?
so he had no legal way to prove that he could occupy the property.
We knew he was there. Like I said, he had no paperwork to say I don't have a lease, I don't have an agreement to purchase. He just was there.
Interesting,
So
yeah.
when we went to evict him, court in Connecticut requires you to go to mediation. Okay, great. So he comes to mediation, and he enters into a stipulation that I'm going to vacate the property. It's like December. I'll vacate the property by the end of March. Great. You pay like a few $100,000 a month for the time that you're going to be there. Great. And he makes those payments. March 27th, he starts filing all kinds of stuff, just to stay, appeals and motions to set aside. I mean, crazy, crazy, crazy stuff. Initially, the courts are receiving it and taking their time and then denying it. And he's such a kook that after a while, the courts aren't even letting him file anything. He's filing appeals on that. He's trying to disqualify judges. He's filing bankruptcy. All in all, so finally we had our writ, and the local sheriff constable went out to take him out like a normal eviction, right? Lock him out, and he's barricading him and his family are barricading themselves in the house.
Oh wow.
So the constable calls local police. Local police comes over, goes, "Nah, I don't get my fingers dirty. I don't need to do this." We finally had to get a federal marshal who didn't care to finally get him out.
Oh wow.
And now he starts coming back and starts, we started rehabbing the property. He starts, putting chain link fence around our property, destroying the stuff, taking the video cameras and all kinds of stuff. So finally, he thinks he's getting. I got to stop points for creativity. So Scottsdale is, corporate, an LLC, incorporated, established in other states, right? So he creates a Scottsdale LLC in the state of Connecticut and says, I own the property through my LLC, Scottsdale LLC, registered in Connecticut. I own the property. And the judge was pretty hilarious. He writes an opinion that says, dude, your argument, you're full of it. Basically, what you're trying to say is, I could say I'm Elon Musk as well as you own this house, right? You can just walk around. You can walk around the country saying, "I'm Elon Musk because I feel like it." He goes, "No, you can't."
Wow.
He still is filing. So then we're still in litigation with him. We've got an injunction
Still
against
in
him.
living, and this has been
Oh
going
yeah.
on for 3 years?
It's been about a couple years, year and a half with regard to
Wow.
this stuff that he's pulling. Yeah.
Has that cost you a lot in legal fee, or you have like someone in-house that manages that? It's just
It's
like a
cost.
more incon.
It hasn't been cheap, and it's just we can't really I think the last thing he did was he actually conveyed the property to his LLC, or conveyed it to himself, which is criminal. We don't. So we've got injunctions and all kinds of stuff. This is just a
Oh
nightmare
wow.
that will never end.
Yeah, this is a little bit more than like nightmare tenant stories, you know. Yeah,
Right.
it's a little that's crazy. So you're rehabbing the property and then you're gonna sell it. That's the goal. If this guy
Yeah.
lets you sell it once you get out of litigation.
Once we get the
Oh
ownership
wow,
interest back. Yeah.
that is insane. Yeah, that's crazy. Crazy people out there. Yeah, Jay, this has been really, really interesting. I have a few last questions going to next segment. What do you like to do for fun other than deal making?
Concerts and sporting events, and we've been doing a lot of that with my three uh, adult sons. We've been traveling around the country a little bit. We were in Ohio in July. We went to New York in August or September. The Diamondbacks just made the World Series. We went to all the playoff games there. Yeah, and my wife and I go to concerts, like local concerts, wherever whatever suits us. So yeah, we spend a lot of time sporting events or concerts.
Cool. That's awesome. What's the most influential book for you in your life? It could be business, personal, or you could have one on each.
3 Feet from Gold, written by a good friend of mine, Greg Reed. It's a
Okay,
story.
awesome.
It's a 3 Feet from Gold story in itself is a story of an old miner in the gold rush days, a guy, insurance guy from back east, who came out to California. He didn't know what he was doing, but he got lucky and he hit a vein. And he's like, so he goes back to back east and he gets investors and gets all this money for all this equipment to keep going forward, right? But he doesn't know what he's doing. So he goes horizontal when he should have gone vertical, right? He didn't know what he was doing. So he gets so frustrated that there's this junkyard guy that kind of was following him around. And so one day the guy gives up and he says, "You know what? Take my equipment. You can have it. I'm done with this." But the junk guy knew what he was doing. So 3 feet from where the guy got frustrated, fed up, he hit the largest gold, largest vein in history at the time. Now, don't feel sorry for the guy. He went on to become very successful in insurance. But the book is about the Gregory interviews, kind of like a follow up to Napoleon Hill, Think and Grow Rich, because he
Right.
interviews guys like the Coldwell Banker guy, a Century 21 guy, like Evander Holyfield, guys that may have been hit bottom at some part of their life. Now you only know him as Century 21, as one of the most successful real estate brokers in the country. Well, he was broke and fending off bill collectors, and just the perseverance and such of how he persevered to become a successful brokerage. Right, that's the stories that are involved in this book.
That's awesome. That's a great story. All right. This is a fun question. If you could spend a day with anyone, dead or alive, who would you want to spend the day with and why?
Oh, yeah. It's funny. I was just at a conference in Dallas with put on by some good friends of mine, and one of the guys that put on the conference um, did what he calls a note talk, and he basically said similar question: if you could have dinner with 5 people, who would they be and why? And he went through a whole presentation of so and so because of their passion, so and so because of their integrity, and all this other stuff. The answer to your question, I guess I wouldn't know because I guess is what day is it? What am I yearning for? If I'm yearning for somebody to inspire me, it could be somebody else. If it was, I don't know. There are so
Who
many
who comes
people.
to your mind right now? Like in the state that you're in right now, who comes to your mind? You get a chance to spend the whole day with this person.
The whole day with someone. Um, Probably it sounds kind of funny. Um,
There's no bad answers.
No, there is and there isn't. I mean, I could say John F. Kennedy, but now we're getting into politics. So there'll be people like say, well, I don't like his politics, whatever. But I mean, he was such a, he was obviously cut short, but what he could have done, what he could have done
Right.
is intriguing, right? Probably somebody like from the Roman Empire, like Socrates or somebody that that really has the and I'm not a deep thinker. It's just somebody that's inspirational.
That's awesome.
You
That's very close to my answer. I would want to spend the day with Marcus Aurelius. I've been reading a
know?
lot about Stoicism. He's a Roman emperor, so I would want to spend the day with him. Yeah.
Right.
Great answer. Yeah. Cool.
I mean,
All right, Jay.
I've always thought of it is if I had a former life, what would I be? And you know what really intrigues me? There's this totally off base of who would inspire me, who I'd want to follow the day with, or who I would have dinner with. But if I was born in a different time frame,
Yeah.
I'd probably and not here's okay. I'll explain what I would be like. Probably a gangster in the like the 30s and 40s, not the horseback riding, robbing banks and trains and stuff like that, but like Al Capone or something like that. And not because I'm a criminal, just because of the deal making, the adrenaline of the deals.
I get that. I get that. Yeah, I can totally see you like getting all excited about that. No, that's I can totally understand that. Yeah. Cool. Now, Jay, this has been really, really incredible. Thank you so much for sharing all the knowledge and wisdom that you have. So anybody that's listening to this show and if they want to be in touch with you, what's the best way for them to get in touch with you?
So go to our website, www.scottsdalemortgageinvestments.com. There's a whole plethora of information. Sign up for our trade desk, and we'll get you started in your investing career because we have assets to we as seller relationships that I started when I first started, we have assets to sell as well.
Cool. Awesome. Thank you so much, Jay. This has been really incredible. Thank you so much for being on the show, and I've really, really enjoyed our conversation.
My pleasure. Thank you so much for having me.
Thanks.